Steve, we're starting to sound like a broken record, but closed-end funds continue to do well as we sit here in the middle of April. I think March was positive for across the board for most closed-end fund asset classes, and then things have really taken off in the first 2 weeks of April as at least all closed-end funds are up another 1% or so, which puts us up, I think, a little over 6 for the year. So is it business as usual from the first quarter perspective? Just capital markets do well, which trickles down to investors feel good and closed-end funds continue to see positive returns and discounts narrowing?
Yeah, I mean, it's simple. It's common sense. Discounts narrow when there's investor demand for an asset class. And both equities and fixed income have done well year to date, which is somewhat of an anomaly, but discounts have followed suit. And so you've got equity funds up 9% year to date. You've got bond funds up about 5% year to date, and that's through the 15th of April. But discounts have been a part of that return. On average, discounts have narrowed about 200 basis points. And so I think, as we said back in January, it's not a stretch to say that if returns continue to be positive, discounts will narrow. Certainly, your average discount is, at close to 4%. One could ask if there's a lot of runway left in that trade.
Right.
But, from my seat, I see a lot of funds trading at 7 to 10% discounts still, whose NAV returns have been equivalent to more popular funds trading at narrower discounts. And so I think if you have the view that, fixed income, whether it's high yield or bank loans or even equities, if you have the view that risk assets will continue to perform well, it would be my expectation that those discounts will follow.
Let's turn to equities for a second. Frequently we spend a lot of time in these videos talking about fixed income and taxable fixed income closed-end funds. And we mention equities from time to time, and usually on the context of equities are lagging from a discount perspective. But when you look at equities this year, coming off a very strong 2016 from a return standpoint, discounts are about 350 basis points narrower this year. And I think total returns lead the pack across asset classes. Has there been a wholesale sentiment change as it relates to equity closed-end funds, or is this simply they lagged for so long, now there's been some rotation into equities finally?
Sure, I think there's a couple reasons. One would be the covered call group has been very popular. And so you've got billion-dollar buy-right strategies trading around par. And I think that's fairly significant when you think about the asymmetry that's really present in that trade. A lot of those funds were trading at 10 to 12% discounts at some point in the last few years. But I think investors are really focused on equity income strategies, and those buy rights deliver that. And so those funds are trading close to par, which brings your overall equity discount a lot narrower. And then I'd say outside of buy rights, there continues to be demand for bond proxies. And so you've got utilities and MLP funds trading well. And then third, I would say that the presence of shareholder activists in the closed-end fund space has kept discounts wider on average. There's very few funds that continue to trade at 15% discounts because fund companies and sponsors are saying, hey, look, one fund after another is settling with an activist, and so maybe we should be proactive. And so I think the combination of those factors, just investor demand for covered calls, investor demand for buy right strategies, and then activists picking up everything those other investors don't want, has caused equity discounts to narrow.
Steve, last question. Clearly, closed-end funds have done well from a return standpoint and from a discount standpoint. When you look at the technicals of the market, is that indicative of increased volumes, more retail investor participation, all the other technical factors you look at, or is it sort of business as usual from that standpoint?
Narrow discounts indicate more retail ownership. And firms like RiverNorth are looking to monetize gains from discounts that we purchase much wider than where they are today. And so we are generally sellers into this type of market, and retail investors that are more focused on price returns and distribution rates are ultimately the buyers. I mean, there's a reason why closed-end funds ultimately trade at premiums, and that's really the clear absence of institutional owners.
Right.
At that point, it means that there's nobody left paying attention to the closed-end fund valuation. It's just...
Is that price? That's price momentum?
That's a lot of price momentum, and investors just buying more of something that works well.
Gotcha.
And so I think from a technical standpoint, the market volume is about the same as it's been for the last year, but clearly you're selling into a retail market if you're selling, equity covered call funds at par. And when I think about the opportunity set, despite the fact that the average discount is narrow, we still find a lot of opportunities in that 7 to 10% range. There's a lot of out of favor funds, whether that's because they have a low distribution rate or a sponsor that's not necessarily mainstream. You know, that creates some opportunities for us, but you really need to be a lot more selective. I feel that way pretty strongly on the equity side. On the fixed income side, I find it somewhat surprising that high yield bond funds continue to be so cheap. If you told me that average discounts were 4.5, I would have just blindly guessed that high yield would be trading pretty close to par in that environment. But you're still able to buy a lot of high yield funds at 8 to 10% discounts. And so I think that part of the market remains pretty cheap. But you know, that's probably a long-winded answer to your question about just market technicals. But again, from my seat, the average discount is pretty narrow. This is not necessarily a time that we would just want to own closed-end fund beta. Our portfolios are becoming more concentrated, and we're really focusing on funds that have distribution stability, relatively wide discounts, and whenever possible, the potential for a corporate action. When you have those sorts of, I think safety is probably not the right word. When you have those sort of factors in the closed-end fund valuation, it tends to cause less discount volatility, which will certainly be more present for other funds. If you've got funds trading at a 4.5% discount, that's a retail market. And I think any sort of hiccup along the way will cause more volatility because firms like RiverNorth don't necessarily step in on the first 2% drop after your closed-end fund's up 40% last year. And so I think you've got some air pockets ahead. But right now, from just a risk management perspective, if you like the asset class, I would say from a technical perspective, you could expect more discount narrowing because the market rewards closed-end funds that are doing well.
Steve, thanks as always for your comments. Look forward to chatting with you next month.
That's my pleasure. Thanks.